The U.S. stock market continued to attract attention in today's trading session, with the S&P 500 and NASDAQ indexes remaining around record highs, while the Dow Jones Industrial Average has been holding back. Behind this volatility are a series of important economic factors, from expectations that the U.S. Federal Reserve will cut interest rates at its upcoming meeting to the latest figures on inflation, the labor market, and consumer sentiment. According to Reuters and several analysts, the Fed is almost certain to cut interest rates on September 17th, and many forecast that not just one, but two cuts will take place before the end of 2025. This expectation is the biggest driver, keeping the market buoyant. However, recent inflation data has investors wary. The Consumer Price Index increased 2.9% year-on-year, in August the highest level in the past 7 months, showing that price pressures are not yet fully under control. This could make the Fed more cautious in making policy decisions. At the same time, the U.S. labor market showed signs of slowing down, as initial jobless claims increased, reflecting a weakening hiring situation. A survey by the University of Michigan also showed that consumer confidence continued to decline, with the sentiment index falling to 55.4, the lowest since May. This reflects people's concerns about inflation, the job market, and business conditions in the coming time. In terms of sectoral developments, technology groups and artificial intelligence companies, such as Microsoft, NVIDIA, Oracle, continue to be in the spotlight, as they benefit from the trend in cheap capital. If interest rates fall, meanwhile energy stocks are under pressure. As oil prices plunge due to concerns about weak demand in the U.S., banks and financial institutions are also facing challenges, as interest rate cuts will affect profit margins. Still, a number of risks loom over the market. First is current valuations. The S&P 500's forward P/E ratio has risen well above its historical average, raising concerns about a bubble. Geopolitical tensions in Ukraine and the Middle East remain destabilizing, with potential impacts on energy prices and global supply chains. With inflation still lingering, the Fed may be forced to act more hawkishly than investors expect. In the short term, the market will likely continue to fluctuate wildly as it awaits the Fed's decision. If the Fed cuts interest rates as expected, technology and growth stocks will have a chance to break out again. Conversely, if the Fed is cautious or economic data continues to go against expectations, a broad correction is inevitable. The question now is the U.S. stock market facing a golden opportunity to continue its rally, or is it just a bubble that is slowly inflating and ready to burst? This will certainly be a controversial topic in the coming days,